Hi, everybody. Happy Monday. I hope you all had a wonderful weekend. Just want to talk to you today about, I'm Kelly Snodgrass with RS Financial Group, and today we're going to be talking about understanding your credit, how it works for and against you. So we will have a little PowerPoint presentation on those of you who are watching on Zoom, and it will later be uploaded to YouTube. So if you're on Facebook Live, you can hop over to Zoom, or you can just wait till we upload it on YouTube and then go to our YouTube channel, RS Financial Group, and watch it there. So understanding your credit, how it works for or against you. And we do have a disclosure. Investment services are offered through Virtue Capital Management, LLC, VCM. RS Financial Group, LLC, and Virtue Capital Management are independent of each other. So the ground to cover today is, what is your credit? How should you use your credit? What goes into your credit score? How do you monitor your credit? What questions you should ask yourself before using your credit, and when should you use cash versus credit? And then we'll have a few real life scenarios. So let's begin with, what is credit? It's receiving something of value and promising to pay later. Sometimes you're charged finance charges. And basically, it's your handshake. It's your reputation as a borrower and tells lenders how likely you are to repay your loan. How should you use credit? Very wisely. If you are just getting started, you should ease into this slowly. Don't rush. Don't accept all of those credit card applications that you receive in the mail. Just start small and make sure you keep your balances at 30% of your credit limit or less. Meaning, if you have a $1,000 limit, then you want to spend no more than $300. And you want to practice self-discipline and also plan for when you can't pay in full. We all think and hope that everything's going to rock along just okay, but if something were to happen, make sure that you will be able to pay. So it's best to sometimes set aside when you're starting to build your credit. So what's going to go into your credit score? It's going to take into account all of your balances and the debt, and these percentages that we're going to go over, they aren't an exact formula. Each bureau is a little bit different, and they don't give their exact formula, but this is kind of a good basis of what makes up your score. So it's going to be a large percentage is going to be your payment history. So how well have you paid borrowers before? Are you late? Do you pay early? Do you go over your limit often? And how much do you currently owe on all of your credit accounts? So that's going to be mortgages, credit cards, all kinds of whatever is furniture, anything that you've purchased on credit. Next is going to be the length of your credit history. So how long have you had a credit history? Did you just start borrowing? Have you recently filed bankruptcy and just starting to rebuild your credit? And a small portion will be for new credit. Have you opened up a bunch of credit cards or credit accounts all at one time? And then a portion will also be how much of your credit is in use. Now, how do you monitor your credit? This is really important because computers make mistakes sometimes, and things could be incorrectly reported to your credit report, which impacts you in several different ways. So annually, you are entitled to one free credit report per year from each of the 3 credit reporting agencies, and you want to take advantage of this, review your credit at least once a year, and dispute any items that aren't yours. So let's see, make sure that they have been removed. Sorry, I can't read that. And sorry, I don't know. Nope, sorry. Having a little bit of trouble. Oh, and make sure your financial life is in order. Now, there are several questions that you should ask yourself before using credit. It's very easy to overextend yourself. So things you should think about are questions you should ask yourself before you make that purchase on credit. Why are you taking on the debt? Is this for something you truly need, or will it make your life significantly better? Can you get this without the debt or without undue hardship on your family, you and your family? And will borrowing for this purchase restrict your ability to maneuver financially in the future? How much debt can you handle without jeopardizing your financial security? And could you pay for this if your income was stopped for a month or more due to illness, injury, job loss, or change? Now, another thing that you really should think about is, why should you use cash versus credit? A lot of people say, well, I would rather just use cash, not credit. There's things that you should think about. Most people don't understand the value of leverage. So paying off your house versus leveraging that asset. And we have an example for you. Say you borrow $100,000 at 3.92% on a 30-year mortgage. Your payment is going to be about $473 a month, making the total cost of that $100,000 mortgage paying back at about $170,000. So let's say you were to take that same $100,000, instead of putting it down on your house, you put it into an investment that earns about 7% a year, or $7,000. So you're going to increase that $100,000 by about 1.3% a year, while you're still paying for that servicing your mortgage. So that interest is helping pay your monthly mortgage. It's growing. And now you've got two assets. You have the equity in your home. You also have the $100,000 cash that's still earning interest. So let's see. And life happens. Don't overextend yourself when making financial decisions, especially when it comes to loans and things that affect your credit. So we're going to have a scenario here, and like we discussed in the first week, you did not start that emergency fund yet that we talked about, and you haven't paid off that cell phone bill that was astronomical because it was just a few $100s, but that person was really annoying. And then you went on vacation with your friends, and let's face it, we're all getting a little bit older, and you were skiing like you were 20 again and had an accident. So now you have to have surgery, and because you blew out your knee or whatever it was, but that's cost you a lot in hospital bills you weren't anticipating. And then unfortunately, that small town you were in was out of network. So that's going to drive up your medical costs more. And you work as a server in a restaurant. So you can't work with that cast on your arm or the crutches because you've broken your leg, and you've had to take some time off of work now. You also didn't have disability insurance or that emergency plan, so now you are living off of your credit cards. And you've now maxed out your credit cards after 2 months of not being at work, and you have several late pays because you're not working, so you can't get the money to make that late or to make that minimum payment. And in the meantime, interest rates have dropped to 3%. So you have a mortgage that a couple of years ago, you bought that first house and your mortgage interest rate was 5%, which was really a great rate when you bought your home, but now it's 3%, which is an even better rate. So you would love to refinance. Well, this is how your credit score is going to impact you. Because you may not be able to refinance now. So let's say you borrowed $100,000 at 5% for 30 years. So you're going to be paying $537 a month or so, or a total of about $193,000 for that $100,000 loan. Now, let's say that we're now at 3%. So obviously, you would love to refinance to save 2% in interest, which makes a huge difference over 30 years. So it will help with your monthly payment as well. It's going to drop down to $422 a month. And that's going to be about $152,000 total for that $100,000 loan. So that just that refinance, which you're going to have to take into account fees and all, but it's going to save you about $115 a month, or almost $1,400 a year. And over 30 years, you're going to be saving almost, $41,479 in interest, which is pretty substantial. So let's recap the lessons we've learned and why your credit is important. So you want to make sure you use your credit wisely, ask questions before purchasing, and don't overextend yourself. Weigh your options on cash versus credit, and keep your financial house in order. Monitor your credit report annually and dispute when necessary, and make sure you're covered properly with your insurance and or emergency fund for those times life happens and we're not really prepared for it. Now, I was hoping that we would be able to get to how to improve your credit, but we are out of time. So we'll be back on Monday, June 4th, and we'll go over some pointers on how to improve your credit. And let's see, sorry about that. Next week is Memorial Day, so we will be off next week, and we'll be spending time with our families, and would also like to thank those in the military for their service and remember those who are no longer with us next Monday. And we look forward to coming back on Monday, June 4th. And make sure you like us on Facebook. Our page is RS Financial Group. And subscribe to our YouTube channel. That way you can stay up to date on all of our webinars each week and learn more. Oh, yes, and you can call us if you have any questions at 901-312-1630 or visit our website at rsfinancialgroup.com. Thanks for watching, and I hope you all have a great week and a wonderful long Memorial Day weekend, and we'll see you back here on June 4th. Thanks, everybody.